Hello everyone, the CPI report has just been released and the number came much better than expected. Let's have a look at them and stay tuned until the end because this is really setting the tone for the Fed to take action. And this could be actually a good news for the equity market going forward, and it's going to help the bull market to continue and to even accelerate. So stay tuned. Welcome to Smart Investing. Please subscribe, like, and leave a comment. That's going to help the channel to grow and to reach more subscribers. Let's get into it. You can see that the core inflation rate month over month is 0.1%, better than expected of 0.3%, and lower than the prior period of 0.2%. The core inflation rate year over year is about 2.8%, better than expected at 2.9%, and the same level as prior period of analysis. You can see that on the chart that from the moment we reach a peak in February 2025 of 3.3%, the rate has come down gradually month after month to reach a level of 2.8% today. CPI inflation rate month over month 0.1% as opposed to 0.2% forecasted, and better than the prior period of 0.2%. Again, if you look at the change month over month, you can see that February was the highest of 0.5%, and since then the rate has been decreasing to reach a level of 0.1% in June. Inflation rate year over year is 2.4%, better than expected and 2.5%. And you can see again from this chart that when we reach the level of 3% in February, because it peaked from October 2024 to February 2025, to reach 3%, we have been on a very consistent decreasing rate month after month to reach the June numbers of 2.4%. So if we go into much more detail than that, you can go to the release report of BLS, the Bureau of Labor and Statistics. You can go directly into the website, is bls.gov, and you will see the report released today. So let's look at the numbers that we've actually just discussed, and we go into more detail where the inflation is coming from, where it's decreasing, and what we can expect going forward. You can see that January you were a peak of 0.5%. Now we are reaching a 0.1%, and you see that we are reaching the same level of July 2024 last year. This is the difference with all item inflation and all item less food and energy in red. You can see that all item less food and energy is around 2.8%, has been stable since March, April, and May, although that the all item is much lower than all item less food and energy, and now we are exactly the same level of 2.4% year over year. If you look at the detail, what has been the key factor for decreasing inflation, that's more or less the energy sector. You can see energy is minus 1%, energy commodity minus 2.4%, gasoline minus 2.6%, and you can see some utility gas services of minus 0.1%. What has been the key contributors of inflation? You have, of course, some electricity bill, 0.9%. You have some medical care and commodities, 0.6%, and you have some shelters cost of 0.3%. So when you see the unadjusted 12 months ended in May 2025, you can see that the key contributors to less inflation has been clearly energy and commodities for the year, because we have minus 11.6% and minus 12% for the gasoline and all types commodities. You can see fuel oil is minus 8.6%. What has been the key contributors to inflation on the unadjusted 12 months ended in May 2025? You can see that utility gas services has been a key contributor to inflation of 15.3%. What also has been a key contribution to inflation is electricity. And what else can we see? We can see that shelter has been also a key contributor to inflation with 3.9%. So this report comes amid global economic turbulence and trade tariff uncertainty, shifting in energy prices, and persistent housing costs. Analysts and central bankers alike have been watching for signs that inflation might stall or even surge. And actually, that is not happening at all. What we are seeing is a very consistent decrease on inflation, whether it's on a full item basis or a core inflation basis. Of course, the market responded positively and stock today a nudge higher. Investors now expect the Fed to hold interest rates steady for now, perhaps even pivot the cut by year end if inflation cools further. So you see, you have a good employment report, slightly weakening, but still very good employment report. And now you have a very good inflation report. So there is no really big hurdle for the Fed to decrease by 25 basis points or 50 basis points going forwards. I don't see how it can really fuel more inflation going forward. So now the Fed job is really to help the economy to grow faster, the loans to be cheaper, to help the housing market to improve, and also to make sure that the small cap and some companies can refinance lower their debt and their leverage position. So in short, today's CPI report is cautiously reassuring. Inflation is easing, yet service and shelter costs could keep pressure. For consumers, that means some relief at the pump, but rent remains really high at the moment. So if you haven't already reviewed your household budget, rising housing costs may call for adjustment, while falling energy price fill up some. What does it mean for the equity market and the bond market? So at the moment, there's still a lot of uncertainty, because if we look at the equity market today, you can see it has been positive for small cap rising, also for the QQQ rising 0.38% and SPY rising by 0.27%. TLT has not moved at all, with 0% change today. So that means the bond market is not expecting that the inflation report will help the Federal Reserve to cut rates. And I think it's a positive for stocks, because less inflation means there is more real earnings and real profitability, and the case for decreasing rates becomes stronger, even though it's not going to materialize in the short term, but it's still very supportive to equity market at the moment. You can see that the 20 years rate has slightly decreased by 32 basis points. The 30-year rate has decreased by 10 basis points, and the 10 years rate has decreased by 70 basis points. VIX has decreased also sharply, about 3% today, so which actually bring the VIX to a level of 16.3%. Is pretty much in line with we have been seeing this level at the low level of 2024-2025. So that's a very, very good news for equity market, and that should be, again, like I said at the beginning of this video, supportive for the equity market and give some fuel for the equity market rally going forwards. I think it's all good news. If you have other views than the one that I'm just giving you right now, do you think that is going to be supportive for the equity market? Do you think it's going to be very supportive for the bond market? Do you think there's still a lot of uncertainty with tariff and all the political cycles that you've seen right now internationally, I would say globally, whether it's in Europe, whether it's in US? I mean, we've seen the BCA decreasing rate quite sharply. Now we are just at a level of 2%, and in the US we're still at a level of about 5%. I mean, do you think that the dollar will start to appreciate, considering the differential of interest rate? Do you think that the Fed is going to cut interest rate in the next meeting? So please leave a comment and subscribe, and more importantly, please like this video. It's going to help the algorithm to make it available to a lot more people today. Thanks so much for watching. Have a good day.